In the meantime, we have breaking news to Steve Liesman. Steve, what do you have?
Scott, the U.S. Treasury announcing its borrowing needs for the October to December quarter, saying they will be $776 billion. A little context on that. It's $76 billion below the prior estimate made in July. However, it is record borrowing still for that quarter. The October-December quarter was helped by revenues from deferred taxes in places like California and the IRS from some natural disasters that allowed them to defer taxes, and now they're being paid. It is offset, however, by slightly higher spending as well. On to the next quarter, the first estimate for the January to March quarter coming in at $816 billion, maybe a bit above some of the estimates I've seen on the street. That is record borrowing for the quarter. However, the Treasury is going to maintain a balance of $750 billion, a cash balance for both quarters. That's a bit higher than I thought, so that ends up increasing the amount the Treasury needs to borrow. We have seen some estimates of $700 billion cash balance. The Treasury maybe being a little more prudent given the way the politics are going, keeping a slightly higher cash balance. So 776, Scott, for the next quarter, and then for the first quarter of next year, $816 billion. Both are records. The first one down a little bit from the prior estimate.
Yeah, bond yield's not moving all that much on that, Steve. It is one of two big events, though, this week from Treasury, right? And the biggie comes on Wednesday. And, boy, there's so many investors who are focused on this refunding announcement from the Treasury, probably unlike any other announcement that they've made.
Yeah, the two announcements go in concert, Scott. This is how much, and then the next bit, which the market's really going to be focused in on, is how. At what tenors will the Treasury be borrowing? How much in bills? How much in coupons? What tenors in the coupons? 2, 5, 3, 7, or 10? Take your pick. 20 and 30, obviously, as well, going to be in the mix. So the market very interested in that. And we're in this phase right now where essentially the bond market and the yield on the 10-year is leading the stock market. And so there is some good news in this. We'll see what happens to revenue here, Scott. One of the economic puzzles out there is why has growth been so strong, but tax revenue been so weak? Maybe it's going to come around and we will get some surprises on tax revenue. It won't change the overall picture, however, which is that the government needs to borrow an awful lot and borrow in record amounts.
Yeah. Steve, thank you. Appreciate that very much. So maybe no big surprises. The market's near the highs of the day. Mike Santoli's with us right now. As I said, the issuance announcement on Wednesday is the one where a lot of folks are focused on, to the point where on halftime today, I said to our investment committee, okay, big events this week, jobs report, Fed meeting, Apple. What's the biggest one to you? They said not on that list. It's the issuance announcement, because that's gotten people all worked up because of what it's done to bond yields.
Right, because from 3 months ago, people have learned the lesson that there's the capacity of this announcement when there's a lot of issuance at the longer end of the curve. Basically, the Treasury rather, attempting to force a lot of folks to buy duration, that was what hobbled the market. That's what got Treasury yields spring-loaded. I will point out 3 months ago, this equivalent announcement came in $250 billion above the prior estimate. So that was the upside surprise in overall supply in July. That coincided with the low in yields and the move we've had higher. So I would characterize today's news with regard to the equity rally as a bullet dodged. You know, we got ourselves worked up. We didn't have an immediate need to be incrementally worried. And now we'll see if this is more than just a bounce. What we're doing today in stocks is essentially mopping up the mess left by Thursday and Friday. We're not even back to Wednesday's highs.
But what do you think today is about in the real sense? I mean, you look at what's working. I said small caps are, they're lagging. They're trying to pick up a little bit of steam. You've got, big widely held stocks like Tesla are lagging and lagging dramatically. But what's this about?
I think it's just about we pulled the rubber band pretty tight. And Fridays have been this occasion since the unrest in the Middle East, since the conflict started, to just get anxious ahead of a weekend. So we did see volatility bid. Look, we closed near yet another what could be support level, right? This area around 4,100. So it was a little bit of a make or break. We're oversold. How much more negative do you want to get? Also, we have no real earnings reports today. So all the stuff that got the market unsettled coming in, really not a lot of macro aside from the Treasury announcement. So I think it's very short term. You have to look at it in a narrow lens. And as I said, we're not back to Wednesday's close.
Well, it's good to have you here to put this into context, what Liesman was reporting and what this market activity is all about. We'll see in a little bit.